You're listening to the ROI channel. Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And if you can hear excitement in my voice today, there's a very good reason for that, because my next guest is an expert in one of my favorite sectors, the oil and gas investment space. Shubham Garg from White Tundra Investments. Today, we've got a cracker podcast for you guys. We're going to be talking about macro commentary. Shubham is going to break down the oil and gas sector from the demand and the supply side. We're going to talk about recent news such as OPEC related news. And obviously, we're going to have our favorite ROI segment, where Shubham breaks down his best investments and where he sees the opportunities in the future. A quick disclaimer, guys, obviously anything that's said on the podcast today is purely for general informational purposes. We're just two guys that are fanatic about the oil and gas markets. Nothing is to be considered investment advice or solicitation to any specific securities. Now, with that out of the way, it is my great pleasure to welcome Shubham to the show. How are you, my friend?
Good, doing well. Thanks for having me, Ben. Great to see you.
My pleasure. My pleasure. What I might do, if you don't mind, is give us a brief introduction to yourself, how you got started in the industry, and the work that you do with White Tundra Investments.
Sure. Yeah, you bet. So my background from a trade perspective is in petroleum engineering. I used to live in Kuwait, moved to Canada in 2006, and it's just oil industry was in the blood. Dad was in the industry. A lot of family friends were just in the industry. It was always a conversation and just was exposed to it a lot. So went to the University of Alberta, did my petroleum engineering, and throughout my short-ish career and my internships and whatnot, I always tried to work in the field. So operating wells, doing production optimization, field engineering, working right from the field, try to understand what's really going on a boots on the ground level. And when I graduated in 2018, I sort of decided to just continue that. So working right from the field, I launched a consulting company that did field engineering, but also operated wells at the same time. So I sort of continued doing that. And over the past few years, I've built up that technical knowledge in petroleum engineering, and I tried to mix it with the field operations experience, and then add this financial twist to it in terms of evaluating companies, figuring out what's going on from the investment standpoint on these companies, and bring those three things together to really be able to work on both my investment portfolio and then the White Tundra portfolio as well, which is a completely private fund at this point. So more on the White Tundra front, I guess. We operate on a very concentrated style. So about 30 to 60% of the portfolio is allocated to the anchors, what I call in the portfolio. So very stable, well-known companies that I have a deep connection with, very, very consistent communication with management, and have the upside torque still to take advantage of oil prices and the commodity cycle, but yet don't have that excessive a downside risk associated with them. And then another 30 to 60% of the portfolio is allocated to cash flowing growth entities, more on the smaller side, but also that can really take advantage of the torque on the upside cycle in oil and gas. And then about 10 to 40%, depending on where we are in the cycle, it's growing now into the 20 to 30% range, but 10 to 40% of the portfolio is allocated to the junior small cap space exclusively. So really targeting companies that have something special. So they have a new acreage, they have a new technology, they have a big improvement to an existing technology, or just something unique about them. And I only pick companies with strong management teams. We find in these sorts of companies, the management is really what drives that share price appreciation, that project execution into even a really, really bullish structural market. So moving more towards that here now, more also looking into the private placements and the grassroots growth opportunities So drilling new wells sort of companies, and go from there. And then on the other side, what I do with White Tundra is we try to provide as much information to retail investors as possible. So I host weekly sessions every Sunday now, and we look at 3 to 4 companies. We go through a valuation, a deep valuation session. We'll look at company insights, fundamentals, well-by-well results, production, their acreage, their tax pools, just a complete in-depth insight into what's going on. Look under the hood from both a financial perspective and then the engineering, geologic perspective. So I try and share as much knowledge as I can. I think the oil and gas industry is very opaque. It's very difficult to understand, but it's such an important part of our lives that I think if I can do whatever I can to help investors, that's sort of what I'm here for. So
certainly do a fantastic job of that. Oh, there's so much I want to dive into already. So you have this, and that's key what you touched on. It is a seemingly opaque sector in which to invest. You've been able to have boots on the ground. You've literally worked on these wells. You've got an academic, theoretical understanding from your engineering. Where did the financial skill come from? How did you learn to apply that? How did you learn finance, and how did you learn to apply that specifically to where your edge is in knowing some of these obscure names and knowing exactly what a well can or cannot do? How did you put the financial twist on top of that practical and theoretical fundamental base?
Right, excellent question. So I started investing in oil and gas companies in 2013. Obviously not a great time because 2014, a lot of them collapsed. I did have a few companies go bankrupt within my portfolio. I ended up losing my student loan money because I was playing around with that. And I sort of said, you know what, I need to figure this out. I can't just invest in oil and just say, oh, this is going to go up. It's the company to company peer specific performance is very vital in this industry. So, like 2014 to 2018, 2020 was nothing really happened in the oil industry. It was just the status quo. So I wasn't all that focused on it, still keeping up with what's going on, the new companies, managements, etc. But really when COVID hit, just before that, the entire cycle of oil was turning. We saw supply start to stagnate, demand continue to grow up. And I really started putting a lot of time and effort into figuring out, okay, what's happening here? Then when COVID came, I realized, okay, the supply is just going to be absolutely cratered here because of the lack of investment. And then now we're in this cycle where oil wells decline. And when prices are in the $20, $30 range, a lot of wells get shut in permanently and just lose what they are. So I really spent a lot of time kind of on my own, just running numbers through my head. Like I would be working in the field and I would say, okay, these wells are making 40 barrels and they're making this much gas. We're making this much money off each well. We're paying this much operating costs. So what are we actually making? And then I ran that into, okay, we have this many engineers in the office in Calgary. This is what they're paying themselves, XYZ. And I tried to figure out, okay, if we save cost here, or if we can increase production here, or if we can shut these wells in, this is the impact it's going to have. And I just started running that into all public companies that I was investing in. And I figured out, okay, if it's as simple as this, why can I not build a model around it and then try and forecast what's going to happen at other WTI or heavy oil price environments? And really that's where the idea came from. And I applied that to my own investing portfolio. And just the financial interest has always been in sort of my blood, because the way I figure this out is when oil cycles turn, you don't just make 100%. You make 8, 9, 100%. You can make 5,000% on certain names. If the cycle really turns, as it did from 2000 to 2008, we saw that happen. We saw it happen from late 2008 to 2014. Some name just went up exponentially, and I figured out that, okay, all I need is one cycle to really go well, and you can make a lot of money on this cycle. So I ended up leaving the oil patch in March of 2021, went full time into investing and valuing companies, and really spent a lot of time just looking at wells, connecting with management teams, connecting with engineers, figuring out acreage by acreage what's going on. And it just has culminated into where we sort of are here 18 months down the road.
Fantastic. And you're about a decade too early in terms of your student loan. If you had done it now, it all would have been forgiven. So anyway, there's a timing issue
Right.
there. But
Right.
anyway, that's a perfect segue into the oil and gas space. So what I want to talk to you about today, a few ideas. We're going to go through the demand and supply from a high level. I want to start off with this quote by Cuppy, who you may know. He says that the world's central banker, his name is Brent, and he rules everything. If you're unfamiliar, Cubby's referring to Brent oil. So, what is it about oil that makes it the lifeblood of modern society as we know it? And then we might go into some of the demand and supply questions. But specifically, what is it about oil that enables us to live life as we know it thus far?
Yeah, excellent. So I would almost go one step back and say it's energy. It's really energy that
True.
feeds everything. When we look at the quality of life of people, any development we do, anything we build, anything we consume, it all comes down to energy. And what makes oil so important is that it is the most dense fuel that can be stored and then provide that. And we have a lot of it that's, cleaner than maybe some of the other energy sources, and it's available. It's it's able to be transported without needing to be frozen or liquefied or any other
That's a
sort
key
of
point.
engineering issues. And oil has just been the lifeblood of the economy. Any economy that's grown, any GDP that's grown, you run oil consumption versus GDP, they run pretty much one for one throughout human history for any country. And countries that have had access to cheaper energy have come out ahead in their economies. So um, when we look at what controls basically the world's growth and the world's economies, it all comes down to oil. Oil translates directly into inflation as well. If the price of doing anything, consuming anything, building anything goes higher, that translates directly into inflation. And I think people don't really understand that because they figure, well, it's just gasoline. Well, no, it's the diesel that the farmers use to plant those crops is going to get passed on to you. The natural gas that the farmers use to then dry those crops is going to go to you. The diesel that goes in the semi trucks that transports that grain or fruit from the farm to the grocery store goes to you, goes into inflation. When somebody's building a new apartment building in your city or a house, the bulldozers run on diesel. The steel is made from diesel and manufacturing plants. So it's just everywhere, but it's hidden for the most part. It's almost an inbuilt cost. So people don't really maybe pay that much attention to it. But when the price of everything is going up around you, it's because the input cost of energy, which is most likely oil, is going up. So when Cuppy says it's a central bank, you can do whatever you want. You can collapse economies, but if you don't literally have the oil supply, there's no amount of things you can do that's going to control that inflation or control that demand. And yeah, just a great quote. And I think one that's going to be true for the next decade here going forward.
Absolutely. You can raise interest rates to try and quell demand all that you want, but until you bring supply online, we're going to have a mismatch. And that leads us into our trip around the world. Let's take a look at demand and supply. Spoiler alert, guys, there's not enough supply for the expected demand. However, we're going to do a little bit better than that. If you could touch on from just a high level to give people an appreciation for everyday demand for oil, what is the average barrel a day that the world consumes, and how is that expected to increase moving forwards, considering that we have populations around the world that are just hitting their S curves in terms of their energy consumption? And what I mean by that, guys, is if you grew up in an emerging market, you don't necessarily have the same amount of energy consumption that we in the Western world have. And so as you start to become more economically prosperous, it's natural that you're going to upgrade to refrigeration, to air conditioning, to transport. And guess what? That all uses energy. And so talk us through at the moment, how many barrels a day does the world consume, or BOE? And what is that expected to do moving out, let's say, over the next decade?
Yeah, excellent, like fantastic points. So Right now, if we look at the oil markets, we use a round number of about 100 million barrels per day that is being consumed. And then when we look at natural gas, somewhere about 350 billion cubic feet per day is being used. So it's a lot of energy that's being consumed. Think about just a barrel of oil, which is about 42 gallons, sitting in your backyard. You might have seen them at your mechanics shops. 100 million of those are being consumed every single day. So just to put that into visual terms, and when we look at oil demand, we see it growing about 1% historically every single year. And when there's an event like a recession or a depression of sorts, oil demand doesn't just fall or like slightly fall and then continue on that 1% growth. It will slightly fall and then rebound to the original trend line pre-recession. So when you have something like a COVID event or 2008 recession, there will be years where oil demand goes up 2 to 3% to make up for that sort of lag time that are built in. And the point you made about the S curve is one that is absolutely vital today, because when people move, rightfully so, from riding a bicycle to then driving a motorbike, their petroleum consumption just went up an infinite percentage. There's no number that can correlate. So same when they install an air conditioner, same when they install a refrigerator, it's the same concept. And what we have now is about 3 billion people in the world are at that cusp. They are in India, in Vietnam, in Nigeria, in the Philippines, huge population centers that are moving up that S curve into that, using petroleum way more than they used before. And what's accelerating this is the access to internet. When you look at the access to internet in some of these places, it's again on an exponential curve over the last 10 years. And when somebody has access to Western media, Western culture, Western photography, what do they see? They see people taking road trips. They see people camping. They see people flying. They see people out driving these electric e-bikes or whatever. It's all based on, they want what the Western world has, and you're not going to stop them from it, especially with the amount of populations that are over there. So as time goes on, we see most of the energy growth, whether it's oil, coal, natural gas, renewables, etc., is going to come from these emerging markets, and it's going to come at a pace we have never seen before. I think people have underestimated emerging market demand for a long time. If you read Cornerstone Analytics work on this, they do excellent work on figuring out, okay, what's happening. And so far, it hasn't been a problem because emerging market growth was so small. When we look at ex-China emerging market growth, in terms of barrels per day, it was not a big number. So you could be wrong on it, and it wouldn't really affect the numbers. But now you've got 2 to 3 billion people who are consuming more oil, so that percentage growth on a larger base is just that much bigger. And economists and forecasters are just completely wrong on this. They are not understanding the numbers. They're using some number, 1%, 2%. Look at some of the countries like Colombia, like Saudi Arabia. Their GDPs are growing at 4, 5, 6, 10% per year. And oil demand and GDP are completely correlated. So I think putting the work in and trying to figure out the real numbers, you will figure out oil demand is set up for an extreme rise here, possibly at the expense of the Western world, who are putting a lot of taxation on it to control that demand, Europe and North America.
Yeah, it's hard not to feel like we're on the cusp of a new era. And I know people say that all the time, but it just appears to be the case. When you've got people getting their heads around the fact that it's not oil consumption grows with GDP. Oil consumption is GDP, energy is the economy. There is no creation of new goods and services or transportation of goods and services without that energetic input. So we've got 100 million plus or minus demand per day. We expect that to grow 1% conservatively year on year over the next decade. So we're looking at roughly 1 million barrels a day, or BOE. where is most of the demand geographically situated now? And I've read some interesting work on demographics where in the Western world, we're declining. The few places around the world where people are having more than 2.1 children per every female are in places that you mentioned, like Colombia, in the Middle East, and Nigeria in particular. I believe the number's around 5. Is there anywhere else from an emerging market perspective that's hit your radar specifically as okay, this area's got population growth, it's got energy growth, and it's gonna take off? Is there any other name in particular that's caught your attention?
Yeah, for sure. So the one that I really focus on is that Southeastern Asian bloc. When we look at about 3 or 4 countries in there, we look at Vietnam, which is becoming a big manufacturing hub, and one of the younger populations that's really growing their energy consumption, a country that has inbuilt refineries. So India and Vietnam are both setting themselves up for this growth because they have overbuilt refining capacity to make sure they're not getting squeezed on the refining impacts. They will import crude oil, refine it, either make money on the margin by selling it or by selling it to their own consumers. And any country that I see that's going into this sort of phase, I think, okay, they realize what their petroleum consumption is going to be. One of the world's, I want to say, biggest refineries is going to open in Nigeria in the next couple of months here. So it's sort of a proxy to where things are going. So I would look at Vietnam, the Philippines, Indonesia, and India. I want to say roughly 1.5 billion plus people in that area. And the growth has just been enormous, like in terms of building roads, building highways, building airports, building big manufacturing hubs, all which create an indirect demand. Like when you build a road, it's not just the asphalt demand right there. It's, people are going to drive on those roads, and people are going to use the airports. Well, when they use airports, now they need rental vehicles where they're going, and they're going to go traveling. So they're going to spend money on other stuff. So that's what really creates this compounding effect that I think we really need to pay attention to as we go forward. And so yeah, those countries are the few ones. And then any other place I see them saying, oh, we're going to increase our refining capacity, I go and look at those countries and I say, what's happening here? Why are they so interested in increasing refining capacity? Look at Mexico, building, again, one of the world's biggest refineries, huge demand growth factor. So yeah, that's sort of what I use as a rough tell, and then really focus on getting to know those countries and getting a better number out as things go on.
Wow, that was just a light bulb moment for myself. I'm taking notes as I go here, guys. Now, here's a curveball. With this idea of deglobalization, so off the back of the last 4 decades, we've had declining energy costs, declining cost of capital with lower interest rates. But now things are changing geopolitically. We've got the US realizing that maybe it wasn't the best idea in the world from security of supply perspective to have everything made in China. And those countries that you mentioned, India and or the Southeast Asian countries, are set to do really, really well from a decoupling of manufacturing away from China. And we've got this, I won't say East versus West, because it's more complicated than that, but we have this reshoring, where instead of offshoring to China all of your manufacturing input, you're trying to bring it back home so that you've got security of supply. But that is going to be inherently inflationary because you have to pay workers more and you have to build in that infrastructure that you mentioned. When it comes to this demand that we're seeing, how much of it roughly is transport versus industry versus the electrical grid? Because this is something that people don't understand. They think, oh, well, energy consumption is just electricity. No. We've got transport, we've got industry, and then we've got electricity. Give us a rough breakdown as to how much of that it makes up for the oil demand specifically, or oil and gas.
Yeah, for sure. So it's hard to pin down an exact number, but when we look at rough percentages where we are, about 50% of it is transportation. So we look at gasoline and diesel for our transportation across the world. Road, I should say road transportation is roughly 50%. Another about 7 or 8% is aviation, so cargo, military, and commercial flight activity. About another 5 to 7% would be your shipping, transport, and marine, bunker fuel, etc. So that gets you to about 65%. That's overall transportation. About 5% is electricity generation. So if somebody comes and tells you that we're going to convert the entire world into solar and wind, great. Well, even if you manage to do that in any reasonable sort of time frame, congrats, you knocked off 5% of world's oil demand. So it's really not as big a deal, or I shouldn't say deal. It's not as big a factor as people make it seem like. So with electricity generation and the transportation, we're about 70%. I would say roughly 10 to 15% is industry. So any sort of manufacturing, processing capacity, and other oil used to keep those things going. And then roughly 10 to 15% would just be your other petrochemical demand, asphalts, road oils, and plastics, and other sort of manufacturing that uses petroleum as a feedstock. And another issue that is often ignored, because that t-shirt you're wearing was made from oil. Those sunglasses you wear were made from oil. So, to come here and sit in your Tesla,
even those t-shirts that say oil is bad.
Yeah, even those ones, and the little glue that you're using to glue yourself to the ground.
Oh my
I
God.
apologize. That's made from ethylene, I believe, which is also made from oil. So it's just the reality of the world we live in, and I think that's why I'm very passionate about what I do, because there's a lot of misinformation that's being spread, and a brainwashing of sorts, where people are manipulating information and misleading people into thinking that, okay, we're just gonna get rid of oil tomorrow and everything will be lush green forest. Like, may take a little bit longer than we think.
Absolutely. And interesting to see, with all these efforts being put forth to sort of ram this agenda down everyone's throats. Hang on a minute. Let's take a look at what Europe is about to experience this winter. Reading through bias and interest, I know Josh Young expects maybe an increase in gas to oil demand switching for industry, whereas you're saying normally, maybe 10%, 15% is just used in industry. But if you lose your natural gas supply, which is a cleaner and nice way to do industrial heat energy, well, guess what you have to use? You have to switch it back to oil demand. So at the moment, what are the chances of us going net zero by 2050, like the politicians say? Because there are some people that believe this.
I think the percentage would be closer to zero than any number that I could make up here.
So
now,
that's the net zero, is the probability of us going net zero, not the carbon.
I believe so. I may have misunderstood that. Yes, you're right. A great point. So I think we should be careful here, because a lot of people are net zero, but the way they get to net zero is that they'll go and buy carbon credits from somewhere else, which can be got in a variety of ways, some of which make no realistic sense to what's going on, and they end up at net zero. Well, if we want to talk about, okay, can we actually get zero emissions from the world by 2050? There's not a chance. There is no chance. Like, there's a lot of work being done to reduce our emissions, and rightfully so. A lot of your benzenes and methanes and other toxic gases and whatnot, like they should be reduced anyway, because they create a lot of health problems and other problems for the environment. So I think a lot of work is being done to do that. But I think the pace of it is maybe not really acceptable with the high quality of life that people have come to accept. So there is a fine balancing act there that needs to be taken care of. And like, my firm belief is that just taxing everything is not a reasonable solution. It doesn't solve the problem. Like, just because you put an X amount of carbon tax on something is not really a viable solution, and you're not really doing people a service as humans, going forward. So there are things that are going to come up. There are technologies that are out there, and people are working very hard on them, and I give them my full support. If there's something out there that can be done to reduce these emissions, then we really should be working on them. But I think a lot of things out there right now are just fluff and politicians talking to gain votes sort of thing, as opposed to any real solutions. And it's unfortunate because I think energy companies, including oil companies, do some of the best work on emissions reduction and technologies to transition us into a more sustainable world, but they get the most hate for it. So what's the justification for them to continue in that case, right? If we supported them, things would go a lot better and possibly a lot faster. And I truly believe that, having worked in these companies and having worked for a company, the last company that I worked for, was at the state of the art in emissions reduction. We had entire oil sites running on solar power with virtually no emissions. And guess what? When I tell people that, they say, "Oh, you're just shilling for big oil and you're a liar." Well, I can show you pictures and videos of exactly that. So.
Yes,
Yeah.
sadly, it does seem to be a game of winning votes as opposed to actually looking at solving certain problems. And there are a few points I just have to make. And it seems to be a creative accounting game of this carbon credit system where Germany can say, look, we haven't increased our emissions. Okay, so how did you generate your power? Oh, we imported nuclear power from France, which we're against, by the way. And we made a whole heap of solar panels, which were made in China. Oh, what was the emission standards of China? Were they great? Probably not. But it doesn't matter because on the German balance sheet, you don't see it there. Nothing to see here. And I guess the second part of that is reading through, Alex Epstein's work and understanding, hang on a minute, what progress have we made in terms of emission reductions? What we've been able to do, if you look at that, by far and away, the majority, I believe it's close to 2/3 of the amount of the emissions reductions that we've had, hasn't come from renewables, in inverted commas. It's come from improving the capacity of extracting, refining, and using hydrocarbons. And out of all this effort to reduce our dependency on hydrocarbons, and I may have this wrong, but what I've read is that we've reduced our dependency from something like 86% by like 2% to 84% over the last 20 years. And it's like,
Yeah.
everything that we've done to smash down oil and gas, like this huge wave just to knock it down because we've decided we don't like it. And we've been able to make like 2 percentage points of difference. And yet at the same time, that very industry has made up 2/3 of the amount of improvement. It's wild, absolutely wild. I don't know if you
Yeah.
had any thoughts on that before we move over to the supply side, but I thought I'd mention it to throw it into the discussion.
Yeah, that's a fantastic point. And I think to kind of expand on that, even though they've reduced the consumption by 2 percentage points, the absolute consumption has gone up probably by 5 to 10 to 15 points. We have never used as much coal as we did in 2021.
Yeah.
And I think 2022 is going to be even bigger than that. So, it's not just a percentages game. The world is just thirsty for energy in all its forms. And they will look for the cheapest source. If they can't find XYZ, then they will find whatever is the cheapest, most accessible, reliable source available to them. So, fantastic point.
Yeah, it's so interesting. Okay, so we're looking at a renaissance in terms of energy demand. It's likely most of that's going to fall on hydrocarbons due to their specific properties of reliability, energy density, and ability to be transported, plus their flexibility of use. The big question that we're all asking ourselves is, where's the supply going to come from? What's the current state of global supply? So roughly how many barrels a day of production come onto the market? Where do they come from, and how does that work? I'd love to get your 10,000 foot view on that.
Yeah, you bet. So just before I answer that, I wanted to add one more point to the previous question. There is you discussed creative accounting, and I truly believe that we have done the entire world a disservice by pushing electric vehicles so hard. I think hybrids are such a clear, better solution. You have the small battery that works for your inner city trips, and then you have the gasoline tank or the diesel tank for your longer road trips, and it's one vehicle. Now you're trying to push electric vehicles, which have this massive battery that's mined with all diesel bulldozers, shoving holes in the ground, transporting these things across the world. The vehicles themselves are about 1,000 to 2,000 pounds heavier than hybrid vehicles. So you're creating this impact on the roads that they've never been really built for. And then at the same time, we have no solution to the scale required of battery minerals. Whereas with hybrids, you have little batteries that gets put in there and it just works. Your MPGs go up substantially. So it's almost unfortunate that we've gone that way, because I would have loved to see every vehicle sold being a hybrid. I think it's relatively doable, not even by 2030, by 2025,
Wow.
if they really tried. So it's just unfortunate, but what do you do, right? Once again, there's such a major force funding that that it's difficult to argue against it. But I digress on that. So I'm talking about the supply, more on the supply side. I think the supply also right now is roughly 100 million barrels per day. So roughly call it balanced market. But a couple points in supply that are very, very important. One, historically, the supply of the world's oil has come from conventional oil projects. So your typical non-oil sands, non-shale type of projects. So the Middle Eastern fields, the Russian fields, offshore, your conventional American vertical drilling, even the horizontal drilling. And we're running into a geology problem now, where all the world's easy oil is either being explored, it's being found, it's currently under development, and it's in what we call a terminal decline. So the way it works is what we call a Hubbard's linearization. So when you produce on a conventional oil field half of the recoverable reserves, your entire field will go into a terminal decline, and it will start declining at 4 to 5% per year. You might be able to keep it at that peak rate for 5, 10, 15 years, but then it goes into this terminal decline. And the world's conventional oil production started over 100 years ago. It hit its peak in the early 2000s, and then it went on this decline worldwide. Some of the Middle Eastern fields, the prolific granddaddy fields, as I call them, have been producing tirelessly for 50, 60, 70 years.
So the Gawars of the world.
Yes, the Gawars, the Burgans in Kuwait, some of the other Saudi Arabian fields have been producing for that long. And when we look at the oil prices from 2000 to 2008, that's exactly the shift we went through. It's the world realizing, we can't grow conventional. Demand keeps growing, and most of our supply is in this terminal decline. So what came on, we brought on technologies like the oil sands in Canada. We saw the very, very initial stages of shale. 2008 is not really a good year. Like a lot of people say, oil goes in cycles. 2008, if you just ignore 2008, we have been in an oil bullish cycle from 2000 to 2014. That entire cycle is just one cycle, less 6 months of this collapse. And that was just because of this reality. The conventional oil is ending. We need to find other ways. 2014 onwards, a lot of oil sands projects came online and a lot of shale projects came online. Shale being very, very quick cycle growth. So if I drill a shale well today, I can get production in 90 days, compared to the conventional fields where it takes 3 to 5 to 7 years to bring any material source of production online. So shale came online, it flooded the market, and we had cheap oil for the last, call it 6 to 8 years, because shale just grew. American shale especially grew. American shale geologically is just better. There's a lower clay content. There's a lot of surface area. There's a lot of existing infrastructure in place in America because of the conventional oil industry. So American shale was able to grow very, very fast. And now, as I mentioned earlier, in late 2019, it was peaking. We saw, okay, wow, this thing is beginning to flatline. Not that it's declining, but the growth was slowing down at a time demand continues to go up that 1% per year, that million barrels per day per year. And now coming out of COVID, now shale is just completely neutered. It cannot grow because of acreage, geology, well productivity, labor problems, supply chain issues, and just regulatory issues. So there's this peak, which may not last very long, because when conventional oils hit a peak, they decline 5 to 6% per year. When shale hits a peak, it declines at 50 to 60% per year.
Wow.
So you see where the problem is. We've added this supply that is a treadmill. It is a treadmill running on that incline setting 10 at full speed, very, very hard to keep that going. And that's where we are in the cycle right now. And what did shale do? It stopped investment in these long lead conventional oil and oil sands projects. So because nobody has invested in exploration and development, well, if you choose to invest $1 today, you're not going to get any material oil until 2026, 2027, 2028. And that's where the supply-demand gap is so large, which now has been exacerbated by Russian oil. Russian oil was supposed to grow by 500,000 to 1 million barrels per year in 2022 and 2023. You will be lucky to see it flat. I would expect a decline. I have roughly 100,000 barrels per month decline baked into my general calculation, which could be increased by any sort of regulation change, such as the European crude ban. But just natural declines, 100,000 barrels per month, that's about 1 million barrels per year. So you're now declining instead of growing, and crude is priced at the margin. So that last barrel that the people want is what determines the price. And when you have a gap of 1, 2, 3, 4 million barrels per day, well, there's people bidding on it. And you saw what happened in Europe when that last natural gas molecule was being bid on in, what was that, August, September? And people were like, oh, what's happening here? What's happening? It's because it's that last molecule that sets the price. It's that last barrel that sets the price. And should be a hell of a ride going forward for oil investors.
Holy moly. So you're saying Russian decline was expected before any kind of sanctions, which, by the way, guys, if you thought they come into effect, not until December the 5th. So you got to kind of read between the fine lines there. And a few key points for the average person watching to understand. So when you have an oil field, every day you're running your business is getting smaller, right? Because you're taking oil out of the ground. And the faster you pump, am I correct in saying the quicker, or you accelerate essentially the decline of your reserves? And so this idea, this narrative that's out there at the moment that, oh, we don't need to worry because we can just turn on the shale tap again like 2014 and we can flood the market with all this extra supply, may not be realistic, let's say, moving forwards. We've had this sugar hit of quick, readily available supply from the shale, but obviously that's been rapidly depleted. And how much is left in terms of shale acreage in the US? Or is it time to start looking offshore for shale plays, if you can get the geology that you mentioned? Like, you can't just dig up any old piece of dirt and turn it into a shale patch, right?
Right. Yeah, great point. So when we look at American shale production, the Bakken is in its maturing, declining phase. The Eagle Ford is in its flatlining top phase. So those two are a non-factor to growth going forward. It's mainly about the Permian Basin. And the Permian Basin is the Gawar of shale. So Gawar being Saudi Arabia's biggest oil field, the world's biggest oil field that we have ever seen. So the Permian is now the shale equivalent of that. And what we're seeing is that the Permian has been overcapitalized, which means they could have kept the Permian at, call it 2.5 million barrels per day for 10 years. Instead, they grew it to 4 and 4.5 million barrels per day. Well, now you can only produce that for 3 or 4 years. And then you get into this decline phase. So over 50% of the tier 1 acreage in the Permian is gone. About 30 to 40% of the tier 2 acreage is also gone. So not only is it getting more difficult to maintain this production, it's now costing more and more, which means some companies will say, you know what, I can keep production flat, but why? Let me spend less money and let my production decline by 5 or 10% so that I have more cash on the books to pay off shareholders, to pay dividends, to do share buybacks, to pay off debt. And a complete mentality shift in the way that shale companies operated. They operated on production growth. Now they're worried about free cash flow, which is cash flow after capital expenditures. So when we take all those factors into account, there is a strong thesis to be made that not only has shale peaked, but in the latter part of 2023, maybe even earlier, you could see shale production start to decline going forward. Maybe not because the geology is that way, but because companies are just so restricted on capital and they'd rather keep a lower production base for longer than to keep this higher production base for a short period of time. So definitely a big issue. And you mentioned some other places. So shale is being tried in Colombia. It's being tried in China. It's being tried in Argentina. And you can get a fair bit of shale production from those countries, but they will never have the growth that America did because A, the geology has a lot more clay content. It's just not as streamlined. There's a lot of faulting and natural geologic depositional environments that are not, that don't make sense for excessive shale production. And these countries just don't have the inbuilt road infrastructure, the transportation infrastructure, the pipelines, the refining, the water disposal, the lease construction, the piping. They just don't have it to create that sort of high growth environment that America did, given America used to produce over 10 million barrels of conventional oil. So they've got wells and pipelines and labor and trucks and water disposal wells everywhere, which just makes it that much easy because when you want to drill a shale well, you already have a road. Oh, you already have a pipe yard somewhere. Oh, let's go to the closest town. Half the people there used to work in the oil industry or still do. It's just that much easier. Whereas in Colombia, you're going to the jungle somewhere. You got to build a road. You got to build a pipeline. It's just
good luck with that.
Not conducive to it. Yeah.
It's fascinating. And, the costs, this is before we even factor into the debate that the costs of building a road or building pipeline is a lot different than where it was 20 years ago due to, cost push inflation. And the petrochemical industry has been so bashed that, finding those old hands, just getting the people with the technical knowledge to do this, they're in short supply themselves. And so is it fair to say that the days of drill baby drill are over and it's more, let's keep production flat and give me back my money from a shareholder perspective, like pay me first, and then we'll worry about increasing production when oil gets to some sort of crazy price. Is that fair to say?
Yeah, I would say 100%. And this is one of the most hotly debated topics out there. But I'm in the firm camp that the way we saw oil prices go from $20 a barrel in 2000, let's say, to about an 80, call it $60 to $80 range, 2007 onwards. And then 2010 to 2014 saw this $80 to $100 range. I think the new range here going forward, $80 will be the baseline. 80 will be the 20 of 2000. And about 150 to 175 will be that 2007, 2008 point when you start to see demand destruction really start to impact on the demand side. Hint, that's not going to be the emerging markets. That's going to be in America and in Europe, where you will feel the brunt of that. And why do I pick that 175, 150 number? Because the first signs of demand destruction we saw this year were in June, roughly, of this year. Mm-hmm. And the way you want to look at it is add your crude price to your refining crack spread price, which is the margin to refine 1 barrel of oil, which was roughly $60 a barrel in June. So 120 crude plus 60 crack spread, 180 is sort of where you end up. And I think refining margins as we go on should normalize to that $20 range, call it, which gives us, to get to 180, we now need a crude price in that 150 to 175 range. And when people say this is a cyclical industry, the next drawdown in oil is going to be from $175 a barrel to $100 a barrel. It's not going to be from $100 a barrel to $40 a barrel. And that is a mindset shift. I think when people ask me, why are you so bullish on a cyclical industry? Is because the next cycle is on a higher point than what you're thinking of as a drawdown cycle. And a lot of these companies are in excellent shape. Balance sheets are in phenomenal shape. Stuff we've never seen before. Companies debt free in the oil industry. You would have slapped me if I would have said something like that, even 3 years ago. So given that standpoint, and the fact that companies make so much money at $80, $85, $90 a barrel, if you're telling me we're heading into a regime of between 120 and 150 sort of, and then 175 on the high end, yeah, I'm sitting here laughing because it's just such a glorious change from where we've been in the last sort of 6 to 8 years since shale came on the scene.
You beat me to it. My next comment's around that $80, let's call it floor, with what we've seen recently with OPEC refusing to increase production and in fact saying that, look, we may go as far as a 2 million barrel cut in production. Is that the OPEC put around the $80? And then we see the US coming out and say we might buy some oil back if it goes to $75 after they've just emptied the cupboard in terms of the SPR. That's got to give you a lot. Oh, it's got to give us as investors a lot of confidence around that $80 mark. I mean, that seems like a flaw, as you mentioned, when you take into account crude plus the crack spreads. And then you've got, I guess, logical factors like OPEC's decisions and the fact that eventually, I guess, the SPR needs to be refilled. What other factors play into that $80 to $175 range with regards to geopolitics?
Yeah, for sure. So I think a couple of points on the OPEC decision that need to be mentioned. One is OPEC realizes what's happening here is that if they don't get investment in supply today, oil prices will go through the roof. The undersupply is going to be so large that you would need demand destruction past the levels we saw at that 180 crude plus crack spread to get there. And that's not what OPEC wants. OPEC doesn't want $250 oil prices and 3 million to 4 million of demand destruction. That's not a reasonable environment. So OPEC is more about stability. They don't necessarily have a price, but they've realized, it's requiring about $100 plus per barrel to get people to invest in new supply. So we need to put some stability around that range to give people that comfort of doing that. So this is not a political push to increase inflation in the US. This is not a way to jam a spear in Biden's back, or it's got nothing to do with that. It's a realization that, okay, if we don't provide the stability, nobody's going to invest. You keep draining that cupboard, as you said, the SPR, and then you say, uh-oh, now we're in big trouble. And that's not a reasonable way to run a oil market that, as you said, directly correlates to that GDP number and growth. So that part is important. The other part is OPEC is as cohesive as I have ever seen. And, I've looked back all the way till 2008 so far. And OPEC was always, there's always this infighting, this game theory that, if they decrease production, I can increase it and make a ton of cash. Well, there's two things. One, they literally don't have the supply anymore because of their conventional oil declines. So you're not going to increase and overproduce if it's going to impact your reservoirs. And B, they all realize this collectively that under the leadership of Abdulaziz bin Salman, who's really controlling OPEC at this point, that he has a vision. He has this long-term plan that he's prescribed to them that says, okay, please invest in supply. We will, as a group, try to control the market within this range going forward. And I think the other countries realize that. The countries like the UAE, which has the most spare capacity in OPEC, even more than Saudi Arabia, realizes that, okay, if we just overproduce now, we're not really getting the benefit of it. We're just going to collapse the price to some lower number. And then what? Then nobody else will invest. Then this price goes through the roof. We get taxed. We get all these politically motivated messages. and then the price collapses again. We're back in this sawtooth cycle. It's not good. So the fact that we did hear a word out of the UAE, out of Kuwait, out of Iraq saying, oh, we don't agree with this, we want something else, demonstrates that OPEC is extremely cohesive. And anybody arguing that, I think, needs to prove that something has gone wrong ever since that they first cut production after COVID in, when was that, summer of 2020, somewhere in there. Since then, I have not heard a single OPEC member complain about any decisions that ABS has made. And it just goes to show his leadership. And we saw it in that last meeting in Vienna. He brought people to Vienna, not because he wanted to discuss something in person with them. It's because he wanted to show the world that as soon as he taps the guy next to him on the shoulder, they listen and they say the same message. It's not, people humming and hawing. It's a clear, concise message. And the world has to respect that. And I think people are not respecting that so far. And they will show people that they have a firm grasp on what's going on.
That is so powerful that I think people, as you said, they're sleeping on. 3 points. So reading through the book, Crude Volatility, gives a fascinating history as to the oil market, but particularly what you say about OPEC being a cartel. The problem with the cartel is everyone eventually wants to cheat on their quotas, but they wanted to cheat to the upside. Now we are at, I guess, a point where they're not meeting their quotas. That's what I've learned a lot from Josh Young's work of tracking OPEC's ability to meet their quotas. So that brings me to the second point, is that how close are we to OPEC reaching its spare capacity? Or some people, I've read Go Rosen's reports, suspecting they may get, demand may outpace pumping capacity by the end of this year. And then I can come back to these because I know this is a long-winded question, series of 3 or 4 questions. But what you just said then about OPEC and ABS made me think of another Cuppy meme where he's got the Somali pirate and OPEC's telling Jerome Powell that they're the captain now and that they need to pay attention. But people aren't paying attention for all those services. So, I mean, let's talk about OPEC now not meeting their capacity. What's going on there? There's a lot of speculation. Where do you fall in the camp of OPEC's ability to, even if they did have a spare capacity increase, could they meet it?
Yeah, for sure. So I think the quotas are definitely a good benchmark to go off of, but they are just a tiny bit misleading because certain countries are getting more quotas compared to their production capacity. The quotas were set in 2018 based on a 2018 baseline. Okay. So some countries have lost a lot of production since then. Some have gained a lot of production capacity, I should say, since then. So where am I on the camp? I think the only country with spare capacity today is Iraq to a tiny extent, a couple 100,000, 300,000 barrels per day. They're also having a geopolitical issue, Iraq, amongst the internal country because of their war or their indecisive around Kurdistan areas, which controls a lot of the oil fields. And then the UAE. The UAE is really your target for the one that has spare capacity. They have, I could say, for sure, 500,000 barrels per day, up to 1 million barrels per day of spare capacity. And they're putting a lot of money, ADNOC is putting a lot of money offshore to really increase production. They just actually drilled yesterday the world's longest oil well, about 50,000 feet, I believe it was. So they're putting a lot of work into increasing their capacity and leaving it on the side for now. So that's the country I would really focus on. I think Kuwait is declining. I would say Saudi Arabia does not today have this spare capacity. And when they talk about hitting 13 million by 2027, I think it's a fairy tale. I don't think they will get there. They would be lucky to hit 12. I would say 11.5 would be the absolute max that Saudi Arabia gets to, if that, by 2027. And there's a couple of reasons. One, I think their reservoirs are declining much faster than a lot of people are predicting. I think late stage declines on a supergiant field are unknown. We have never had a supergiant oil field in its declining phase to this nature in the past. So especially when you involve water flooding and you involve a field of this size, 1 percentage point of extra decline every year over a 5-year period is about 250,000 barrels per day on one field. So those numbers, and that's 1 percentage point of extra decline per year. So instead of 4%, if you have 5% decline, the compounding effect of that is just massive. And remember, all of Saudi Arabia's fields are old. All of Kuwait's fields are old. A lot of, not the majority, but a lot of Iran's fields are also getting older. So when you add that up, 15 to 20 million barrels per day, and you run a 5% decline on that instead of a 4% decline, that's 200,000 barrels over 5 years. That's a million barrels. So it's important that we don't have this. It's not an exact science. It's more of an art form, this estimation. So I would definitely keep that as a factor. And the second factor is the fields that these countries are drilling. So Saudi Arabia, Kuwait, Iraq, they're drilling fields that are not their creme de la creme fields. If they were, they would have already been drilled. This is not new exploration. This is fields being drilled shallower or deeper where they already have oil production. So they're going in, they're saying, oh, this field was marginal at $40 oil, at $80 oil, but at $100 oil, we should now produce it, or we have to produce it because their operating costs are so low. They say, oh, we might as well produce it and create production, but they're not top quality fields. So when they say they're going to come on at this rate or that rate, nobody knows that that's actually what's going to happen, because they're using numbers based on their top fields and trying to extrapolate into these lower quality fields. So,
but you're saying that they've kind of high graded already their best production, and now they have to move into these lower grade fields.
Yes. And there might be other production problems. Now, if you're producing a heavier grade of oil, you might run into paraffins, you might run into wax. Your refineries may not be able to produce or to refine this kind of oil. You might run into weird issues with water flooding in a heavy oil field versus a medium oil field. So all these things are unknown. I think Saudi Arabia has just put a number out to kind of show that they have control over the markets, but I don't really think they do. I think under the hood, if I had the opportunity to talk to one of the reservoir engineers, I think I could figure out very quick that there's some significant problems here. I have sort of done that exercise in Kuwait, and I'm just using that as a proxy towards Saudi Arabia. So that's sort of where I end up at. There's some significant issues in Nigeria where production is down by 1 million barrels per day in 5 or 6 years. A lot of theft, a lot of explosions and social risk going on there. So that's a country that's really underproducing quota. I would look at Kazakhstan as possibly one that has spare capacity. If they grew, they could have anywhere between 200 to 500,000 barrels per day if they expanded their Tengiz and Kashagan fields. But again, because Kazakhstan is basically controlled by Russia at this point, their export route to Novorossiysk goes to Russia. So a lot of issues there with that part of the world going forward. So on the overall, when you add all that up, you end up with, there's a problem here. We don't have the supply, and that's where really the issue starts, and that's where it really ends. Unless you solve that supply problem, it doesn't matter how much you reduce demand. You will absolutely destroy the world and still not get oil prices under control and still not get inflation under control.
Wow. So we're sitting on a precarious ticking time bomb as it is, but let me throw some curveballs in there. So that doesn't necessarily even take into account further disruption of supply from something like, say, a war, civil unrest, and things that in those parts of the world, like, they happen all the time. Like, who's to say there's not going to be a significant period of downtime in production from any of those countries that you mentioned? Is there a way that when you look out, can you put a premium on that? Can you look at something and say, well, this is priced maybe fairly in the current environment, but what happens if a field in Iraq goes off to tomorrow for, I don't know, a month or 2 months? How do you think about that? How much of that plays into your assessment of global markets?
Um, it plays into my frustration more than my assessment. I see these things and I see the price of crude falling to 72 or 77, $80 a barrel. I think, how can somebody look at this market and be willing to sell crude, maybe not today, but maybe in 2024 for $72 a barrel? Like, I would never take that bet. That is just such a risky, you're picking up nickels and pennies in front of steamrollers that will absolutely slaughter you going forward. So I think what you made is a very interesting comment, because we have had Libyan production online for the last 3 or 4 months, and nobody seems to think it can go anywhere. We have had Iraqi production online. Nobody seems to think there's a problem. We have had Kazakh production for the most part online. The Russian production, people are taking victory laps and saying, look, we told you there would be no declines. Yeah, it's very easy to operate fields in plus 20 degrees. Try to do the same in negative 10 degrees Celsius with water that likes to freeze, oil that likes to freeze, and you don't have the sufficient services help within the country anymore to alleviate those problems. Things can change very, very, very quickly. And it's sort of funny because there was these things on Twitter saying we should pull military support from Saudi Arabia. Do it. Go for it. The Houthi rebels, as soon as they blow up something in Saudi Arabia, say goodbye to your 2% inflation target. Your new inflation target might be 20% if something major was to happen with the Houthi rebels and the Saudi oil fields. So I think people are just in this lull, this false sense of security. And it's because we've relatively been in peaceful times for the last 10 to 15 years that there's no geopolitical premium on the price of oil today, and it will come back. But why is it not there? I think is the question. And my answer to that is because 99.99% of the world, including the American government, still thinks shale can grow by that 1 to 2 million barrels per day. So they say, if something goes wrong in Iraq, we can add 1 million barrels per day in shale in 6 months. And the SPR release was their first hint. They said, we're releasing SPR because industry has told us they can add 1 million barrels in 6 months. That industry wasn't the producers. That was the Rystads, the Enviras, the Bloombergs of the world, who are still running incorrect models and simulations. And we've seen it. In 6 months, shale has added 200,000 at max, I would say. So the world, as soon as the world realizes that shale is not the 50, 60-year reserve that people were saying, I expect at least a $15 to $20 bump in the price of oil, that like as soon as that narrative changes, because that is really what's holding us back a lot. And my goal, I wouldn't say goal, but a lot of my work these days is focused on showing the world that shale is no longer going to grow. And I do well by well, acreage by acreage, section by section research, well productivity, lateral lengths, and just we don't have the reserve. So I'd really like to focus on that part of my research recently, because like I said, that itself is going to be the defining moment where people start to think we have a problem here. Until then, they're not going to care, because they believe that shale can add 20 million barrels per day if it has to in the next 5 years.
When it's struggled to do 20% of the expected production over the last year or so. I see your point on shale, and I raise you one more. So let's talk about the SPR in terms of what the hell is going on? What happens? This thing has to be refilled eventually, right? How does that look? What does that look like? And here's a point directly related to what we just touched on, which, a disruption from, who knows, civil unrest. The idea, as I understand it, from the US building the SPR was to mitigate the threat of terrorist activity, because if you're a terrorist, one of the great ways to attack the West would be to disrupt the energy supply via blowing up an oil pipeline, God forbid. And so if you build this massive, gigantic SPR, well, that makes it less attractive for you as a terrorist to attack the US because you may disrupt supply, but they can mitigate that by relieving the SPR as they need. And then once production's back online, pipeline's fixed, they can start to refill it again. Are we in a situation where the US has directly exposed itself to an increase in some of these activities, hopefully not, due to this madness of releasing the SPR? What's the go with that?
Yeah, for sure. So I think the SPR still has enough oil to the point where it's not really a concern of mine at this point. I think if they drain another 100 million barrels, I would start to get a little bit worried because at some point, the military will step in and say, look, we need this oil for our national security. You cannot be draining this thing even lower. So I don't think that's quite a concern yet, but there's a different concern on the same thread, which is that America is not just worried about America. America is the leader of the world. So America is the dad, every other country is the kids. Just go with me here. So some people make
we're Australia. We're one of the retarded children. We get it.
Yes, but for the sake of argument, so America needs to have this excess of everything and say, we will provide for you if there's any issues. And that's what they're doing today. The world is saying, we cannot sustain $180 crude plus crack spread pricing. Please help us. So America is doing that. They are effectively subsidizing the world because a lot of oil is just getting exported out of the SPR. But the problem is when you are running at 400 million in your SPR versus 650 million, now that safety net is extremely tight. When somebody sees the SPR, they say, if we have another issue like this for a year, America can't help us no more. Like that bullet in the chamber has been shot. That solution has helped the world for the last 6 months. And if they keep draining it, they can for another 3 months. But after that, that insurance policy is null and void. And that itself is going to bring this scarcity premium back into the price of oil, which could be good for another $10, $15 a barrel if we don't have that. And that, I think, is more the point with the SPR that's important, is that short term, it was a very bearish impact on the price of oil. But when we look at longer term, when you don't have that insurance policy, people have to pay higher premiums. And the premium is the price of oil. And if you want to re-get that insurance policy, as in refill the SPR, you now have to refill $80, $90, $100 oil into the SPR. So if you do that, that insurance policy will not be used unless oil is $180 to $200 per barrel, right? You're not going to pay a $500 deductible on your insurance to fix a $300 windshield, right? That's not how it works. So even if they refill it, A, it would be a bullish factor where they're pulling supply from the market, and B, the world knows it's not going to be used until the price of oil is much, much, much higher, which leads us to an open possibility of things like that happening. So from that standpoint, I think the SPR has been extremely frustrating. They have really came in and affected the market. They have reduced new supply investments from being made. I myself have pushed back some potential investments into drilling new wells that have been pushed back 6 months, a year, 18 months, whatever. I know other people who are in the same boat, and it just caused more chaos. They should have been releasing at a lower rate, not just flooding the market with 1 million barrels per day. But given where we are today, I feel very confident that the SPR is running on fumes as far as impact in the case of a supply, like a undersupply long-term issue. In a short-term hurricane or pipeline disruption, I think the SPR is still enough where it can come in. But those are short-term pricing dislocations. And when we invest, we're looking for long-term thesis. And that's where the SPR is just a completely bullish factor going forward.
Wow. Two more things before we move on to the ROI segment. How does it actually look in terms of them refilling the SPR? I've seen some crazy ideas on Twitter saying something like, oh, don't worry, the US government can buy lots of calls on futures. And I say, okay, that's in the paper market, but they've still got to be able to get those physical barrels into the inventory. Maybe comment on that idea and then talk us through the difference between the paper and the physical. In some markets, like the metals markets, notorious for its disconnect between the paper and the physical market. What's the standard of the paper versus the physical for the oil market, and how does the US go about actually eventually refilling that SPR?
Certainly. So I think if they do buy futures market contracts, they can force delivery on those contracts. So certainly an option. That being said, if they are looking to buy 200 million barrels worth of contracts, it would really impact the price. It would push the futures curve up, which would then push the current curve up because we are still in a physical shortage. So the curve has to be in that backwardation sort of cycle. So how much would it push it up? 200 million barrels is a lot of oil. So that could have a significant, severe impact, even if it's across the curve, like not just 1 month, it's across the curve. That's a big player in the market. So they could definitely get it done, but not without a major pull up on the market, which they don't want to do that before midterms, I assume, 100%. So that's the point on that. The comment on, sorry, what was the second question?
The question around the paper versus the physical. Right. So how much leverage is in the derivatives versus the underlying, I guess, barrel market?
Right, for sure. So the paper markets control everything. Any commodity, any stock, any equity, the paper markets control everything. However, the oil markets, the physical oil markets are about 3 to 5 times as big as every metal combined. That's how big the physical market for just oil is, let alone products and gasoline and everything else. So what ends up happening is you can control the markets for short periods of time by dumping contracts or doing whatever. But the physical market is so huge. And we saw this earlier in the year where the paper oil was trading for $89 a barrel, and the physical oil was trading at $105 per barrel. There was a big difference between paper Brent and dated Brent. Paper Brent being, I will take delivery in December. That would be paper Brent. Dated Brent would be, I want delivery in the next 7 days, sort of thing. So those prices were about $10 to $15 difference already. And arguably the physical market was less tight than it will become in the next 6 months. So that's one point. The other point on oil compared to metals is when you have metals, you have gold, you have silver, it's sitting somewhere, right? It's in some vault, it's in some mine, in some train. Oil, when you consume the gasoline in your vehicle, it's gone. It literally goes into thin air. Poof, disappeared like magic. So you can only really, I don't want to say manipulate, but you can only really control the markets to some extent. And at some point you say, hey, I'm selling all these contracts. Where's the oil? I don't have the oil to physically give to you. And you're going to see the opposite of that negative $37 oil situation happen. It may not be next month. It may be sometime next year. But you will see a certain contract that will go to all-time highs. That will not reflect the actual curve. It will be just that contract. Why? Because XYZ trader would have thought, I'm smart. I'm going to sell all these future contracts and make a ton of money. And then it comes time to deliver those and they go, where's the oil? There's no oil in floating storage. There's no oil in my tanks. There's no oil on the trains. The producer can't produce the oil fast enough. and they will have to go and buy that oil from some random source. And the source will say, gotcha, I'm not selling it to you for $100. You can pay me $175 and take it off my hands. And that's exactly what that trader will have to do. And that's what I think some of the physical market will start to take over, because these financial people will just say, yeah, this is a little too risky at this point when we don't have access to the crude. And that brings me to another point on the SPR. The SPR was almost a safety net for these traders, where they could, worst case, they could go to the government and say, please, I need help. I need these barrels.
I need to cover my shorts.
Yes, and I will give you these barrels back in 3 months. Well, now the government will say, no. The US Air Force has control of these barrels. And you go to the Air Force and ask them, they'll say, you want what? No, hell no, we're not giving you these barrels. And it takes away that lifeline that these traders had. So from that standpoint, I think people should be very careful. I use this a lot, the picking up pennies in front of steamroller line. You can do that for a little bit, but as soon as that steamroller goes, it will absolutely crush you into the ground to where you become asphalt. And I don't know why people are taking those sorts of risks with the market that's obviously headed upwards, unless they find some magical source of energy in the next 3 months, call it.
So hypothetically speaking, of course, if you were an Australian ex-physiotherapist investor who had bought some out of the money calls in, let's say, 23, 24, 25, you might be driving the steamroller as opposed to picking up pennies in front of it. Interesting times.
Yeah, great analogy.
I want to move on to the specific segment of the channel, which is, of course, ROI time, guys. This is where we really get into the meat of the discussion. I would love to know what is your highest ROI from any investment to date? Maybe if you can talk about the numbers, jump into those. Otherwise, just give us a background as to what it was and how it came about.
Interesting. Okay. I don't really have any massive wins. A lot of my wins, I will let go of them at 150 to 200% upside. So I would say my biggest win, I would say would be Surge Energy, because when we were in June of this year, I think I was sitting on roughly 180% gain on that one. It has since come down to about 120% gain or so, I believe. But I would say that would be my biggest. I also had Athabasca Oil in early 2021, which I had built up a massive position. About 95+% of my portfolio was in Athabasca. And we ended up, I think most of my portfolio was out in that 200% range, but I did keep some shares that ended up maybe 250%, but nothing more than that. I like to exit those and recalibrate my portfolio when something like that happens. And the way that I run my portfolio, as I described earlier, up to 60% could be in one equity. And if that equity runs 200%, I'd rather take the gains and then redeploy accordingly. So yeah, I would say those would likely be my biggest. However, I'm quite confident that some of my small cap plays that I currently have in the portfolio will end up at possibly being my biggest ROI gains in the next 2 to 3 years, let's say. And those I will hang on to longer because they are relatively illiquid. And as they grow, I think it makes more sense to hang on to them and let people come to you as opposed to you sell into the market. Yeah, because people are going to want these names at some point for sure.
You're listening to the captain of the steamroller, ladies and gentlemen. Your highest conviction stock currently, is there any, I know that there's probably heaps, but is there any one that stands out as to it's something that can really outperform over the next, say, 2 to 5 years, and tell us why you think that is?
On what sort of risk profile? I guess I should.
Okay, so let's go with maybe one of three. Let's go with a bigger mega cap producer with maybe a lower risk, higher economies of scale, but it's not going to have the moonshot to the upside, but maybe a high enterprise value to free cash flow, and then maybe a medium producer, and then an explorer slash small cap that you think has massive torque to the scenario that we're both envisaging for oil's future?
Right. Okay. So I would say on the more bigger company side, something like a Meg Energy, I think it is extremely compelling. It's a company that has spent all its money building the oil sands mine that came on in the earlier part of last decade, mid part of last decade. Since then, they haven't really been able to take advantage of what really is the top quality oil sands formation and geology, because oil prices have just been low. But as they go into this cycle, they've paid back about 75% of their debt. They now have 50% free cash flow going straight to a buyback to try and re-rate that stock. And they have upwards of a 60-year reserve life. So they don't need to spend any money on exploration, like going out and buying more land, doing more excess developments on the side, nothing. They just produce their 100,000 barrels per day mine. It's not a mine, it's a SAGD, steam-assisted gravity drainage oil sands facility, and spin out cash, which goes back to buybacks, which really drives that re-rating going forward. Meg Energy also successfully defended a hostile takeover in 2018. So a lot of the shareholder base is extremely strong. They know what the value of this company is. And as you take away those tourist investors / traders with the buybacks, you get to this very strong shareholder base who don't want to sell. So it's going to drive this sudden re-rate, because the stock is filled with these people who want 100% plus upside before they sell it from these levels. So that would be one on the larger side. On the small to mid cap, let's say, side, I really believe in Crew Energy. I think the reason why this is so compelling to me is because they have a massive land base. So they have, I want to say, like 300,000 acres of Montney rights. And why is that so compelling today? Like why am I not mentioning Surge Energy or an Obsidian that's a conventional producer? Because the M&A activity that's going on right now is in the unconventional shale side. A lot of companies are interested. We want shale. We want huge production growth. We want these massive wells. And Crew Energy happens to have multiple tier 1 acreage properties. You can have liquids-rich Montney or the gas Montney. It's on the Coastal GasLink pipeline that's going to be feeding LNG Canada. So access to that takeaway capacity and high-priced LNG right there. Not high-priced, high netback LNG BOE right there. And they're relatively debt-free here. They have a huge uplift on net asset value, so reserves in the ground, and they're beating all their production numbers. So their cash flow per share is going up substantially for a, call it 15 to 20% production growth company. And then you add that to the fact that they're retiring debt and they have this large net asset value. It's just 3 or 4 factors that are going to create this to be the shale buyout target if any American companies want to come in, or even Canadian companies want to expand their acreage. And then if we look at sort of the micro to small cap side, I would say my highest conviction pick right now is Prairie Provident Resources, PPR. It's not on the venture, it's on the actual TSX exchange, which gives it a little bit more liquidity. And this company is about $30 million market cap and about 120 million of debt. However, that debt is with a very, very strong supportive debt holder. And this company right now is working on a deal. They have some assets for sale that could potentially wipe out more than half the debt, which not only re-rates the stock, you save a huge chunk of interest costs. So when you're paying 10% interest on 60 million, that's 1/5 of your market cap going to debt interest every single year that you're saving. So that's one factor there. They're also organically growing production, drilling really, really good wells. They've come in with a new management team that has previously brought back Obsidian Energy from the dead. So they're masters at bringing companies that have been poorly run back into the market focus. And this company has about $800 million of tax pool. For a company this small, they have a lot of tax saving bonus, which makes it a prime candidate to re-rate on that buyout target potential. Because a lot of companies have tax pools in Canada in 2022. It's about 30% are running out at the end of this year. And going into mid to late 2023, a lot of companies will want tax pools. And if they can buy these small little companies everywhere, not everywhere, there's not many of them. If they can buy these small companies with massive tax pools, it's a natural fit in there. And the management team is just exceptional here. One of the best conversations I've had. And yeah, we own a pretty significant part of the EV. It's only 30 million, or sorry, the market cap. It's only a $30 million company. But between myself and my connections, for full disclosure, I believe we own more than 10% of the company at this point.
Wow. And as that debt starts to come down, as you mentioned, the interest savings that's then going to be available on the bottom line is
Right.
a huge percentage of the market cap. Incredible.
Right. And one thing I missed on that is that they have about 50% of their oil hedged at roughly $62 or $65 WTI. That drops off completely on December 31st. So imagine half your oil
Happy
goes
New
from
Year.
$62 to $85 to $90. Happy New Year and a Merry Christmas. Yes.
Fantastic. Oh, that's music to my ears. I had a couple here of my holdings. So full disclosure, I own shares in these companies. You mentioned Meg, which is just a phenomenal play. One more comment on Meg, because I want you to correct me if my thinking is wrong. Let's say they've got, say, call it 3 decades worth of P1 reserves. And today the company's trading at anywhere, let's call it 30% free cash flow yield. Am I correct in saying that I'm getting, let's say I'm paying 2 to 3 years worth of inventory and then getting maybe 27, 28 years for free? Is that how you look at, there's oil in the ground, I'm paying for X amount based on the cash flow yields, and then depending on whether I want to use P1, P2, P3, does that weigh into your valuation, or do you look at things differently?
Yeah, that's one way that I would do it. I would say that as the cycle continues, a lot of big funds and institutions are focusing more on net asset value, as you mentioned, the reserves, as opposed to the free cash flow, which they think, we don't really believe these free cash flows. They're exposed to commodity risk. They're exposed to volatility. We want oil in the ground. So since a large portion of the money, the capital focuses on net asset value, I'm really loving companies these days that have that net asset value proposition. And your point on the years of inventory is exactly bang on. That's how I would think of it, but I run it a different way. And the way I do that is I run my net asset values, instead of running that at a 10% discount rate, I'll run it at like a 5% discount rate or a 7% discount rate, because I know that oil in the ground should not be discounted at 10%. It's getting really hard to find oil. The supply is getting hard to find. High inflation environment, that oil is worth a lot more than discounting it at 10%. So I'll put an NPV 5 or an NPV 7 or 8 on it, and then I'll run my 1P reserve at that. And what you'll end up finding is the value goes up substantially, because when there's something 20 years out at a 10% discount rate, it's basically zero. Mm-hmm. But you run it at a 5% discount rate, all those terminal years start adding that incremental value. And I end up getting real net asset values, not what XYZ company is saying. So that's one way I would approach it, to put an actual valuation on it. Because when you tell people you're getting 27 years for free, they don't really have a way to bring that back into a share price. Whereas doing it this way, I just find it easier to tell people, okay, this is what I did and why. and I ended up at this net asset value. Therefore, my price target is this.
Yeah. And if you've been a little heavy-handed with the discount rates, just because, yeah, I guess investment banks are used to using,
Right.
NPV 10, just
And yeah,
this kind of arbitrary thing.
yeah,
Well,
yeah,
that 2 to 3 percentage points worth of discount rate, as you say, over decades, that makes a huge difference in terms of the compounding.
right.
I never, yeah, I never would have thought of that, but it makes total sense. Here's one: Journey Energy, one of my favorites, one of Josh Young's favorites. Couple of comments. It's done, as far as I can tell, very well in its acquisitions, buying assets from, I believe, mainly Enerplus at
Mhm.
very, very good valuations. And particularly, this company seems to have a very low decline rate. What's a decline rate of maybe 12 to 14% worth in this kind of environment? And what's it versus a typical decline rate of what, maybe 20%? Would you say is fair to use as an average decline rate?
Right, right. So just before I start on Journey, I did want to make a funny point is try and pull up any decks, slide decks of any wind farm or solar farm. They're all run at NPV 8. So anyone telling me that NPV 10 is like, oh, it's just our standard and that's why we do it. No, you're just trying to make one thing look bad and the other thing look better than what it really is. So I'm watching. I got my eyes here as to what's going on at these banks. But to come back to Journey, I think extremely strong management that gets it. They have significant skin in the game. Alex is a top tier capital allocator. He's seen the cycles. He's been through basically sitting in the graveyard with somebody smashing his face in, and he's recovered from that. So somebody with that sort of battle scarring is going to look at things a lot differently when times have changed, and taking full advantage of this cycle. So that Enerplus acquisition, I think, people run multiples of this on the acquisition. It's not the right way to do it. You have to look and say, okay, they bought this many barrels, and they are going to actually capitalize an asset that has been ignored in a bigger corporation, and there's low-hanging fruit. There's wells that are maybe a $10,000 fix, and Enerplus just never bothered to care to do it. So Journey comes in, they increase production by 20, 30, 40% cheaply. They drill some more wells, they do a bit of water flooding, and that production number and cash flow is what the acquisition metrics should be run at. And when you start running metrics like that, I see deals that, at 1.5 times cash flow, at maybe 2.5 times free cash flow sort of number. And that's where the low decline rate really helps. When you have a lower decline rate, you're not having to spend as much money to keep your production flat. So any incremental barrels you bring on now allow you to increase your production, as opposed to barely keeping your mitigating decline rates. And this is something that some companies are going to really suffer from, especially shale companies. We already saw SM Energy and Laredo come out and say they missed production for Q3. So when you have a hard decline rate in a high inflationary environment, it's just a recipe for disaster. So the lower decline rate also helps you mitigate inflation, because you're not having to spend all this money just to keep your production flat. So, I'm very happy with Journey. I think if they continue to make acquisitions, they are in this niche where they have this scattered land base, but they have neighbors they can buy out these existing assets for very, very cheap in various formations, where nobody's really competing with them. So they're set up very differently. I believe they'll be debt-free even after this acquisition by the end of next year, and very low share count. They have access to different ways of capital through AIMCO, which is the Alberta Investment Management Fund. So they're very supportive of this company, and access to capital is getting to be a big, big, big issue. And Journey having that puts them, I think, in a class of their own, along with some other companies, but it's still a class well above the rest of the companies. This is a name I owned earlier this year, had a really good run on it, and ended up moving into something else. But I really respect the management here a lot.
Yeah, and I mean, from my understanding, be completely unhedged moving into this high price environment. So a hell of a lot of that's going to drop straight to the bottom line. People are a little bit unhappy that they did do a slight equity raise, which generally speaking dilutes your interest. But the reason they did that was to make an accretive acquisition. So in the end, I mean, it makes a lot of sense when we're talking about wells with, at least according to presentation from management, with triple digit IRRs. I mean, I guess that's the one situation in which you're happy to have some dilution if that acquisition is going to be accretive at these types of IRRs. Moving on to Surge Energy. This is one that's been talked about quite a lot. The idea being they've got a net asset value of a certain price that, or value that might be 3 times the share price at the moment. What are your thoughts on Surge?
Yeah, and that net asset value of 3 times the share price is, I believe, in an $80 price deck. So if you really believe in what's coming here, I think those things are going to get re-rated substantially. But Surge has been my biggest holding for almost a year. The only reason it dropped is because in late September we ended up getting a margin call, and I lost 60% of my position. But it was my largest position since June of 2021 until September of this year. And even in my personal portfolio, it makes up anywhere from 30 to 40% of that portfolio. So I'm really a big fan of management here as well. A very aggressive, high passion management, running 3 or 4 oil fields that are exceptionally prolific. They have 2 of the top 4 fields in North America in terms of the 2x payout. And why do I use 2x payout? Because I want to know when I put $1 in the ground, not just when I made that dollar back, I want to know when did I make that dollar back and get $1 of profit, as in doubled my money. And you'll find a lot of shale plays have really good IRRs, but that second payout almost never happens because the well has declined so much by the time they get to the first payout. So completely misleading on a lot of shale numbers. And Surge has two of the top 4 fields when you look at 2 times payout, because once you get that second dollar back, that second dollar now drills your next well completely out of cash flow without needing any more capital. So for a company like Surge, I think having access to those fields is extremely important. They have a very low debt now. They've been paying back debentures. They've been paying back their bank loans, and they've restructured that bank loan. And there's 2 things here that get me really excited from an engineering geology perspective. One is a multilateral play that is getting big in Canada. So instead of drilling vertically and then horizontally, they now drill vertically and they drill up to 8 legs horizontally. So the same vertical has 8 to 10 legs on it. They don't require steel and they don't require fracking. These are completely open hole legs. So you save on capital cost and you expose yourself to 8 times the reservoir in a way more environmentally friendly way. No fracking, no steel, which are the big supply chain and inflation factors these days. And you are able to convert sometimes tier 3, tier 4, tier 5 land into tier 1 or tier 2 land. And Surge is the biggest landholder in the Sparky formation, which is where this multilateral play is really picking up these days, other than the Clearwater. So now they can go into certain parts of their acreage that were uneconomic, that didn't compete for capital in an $80, $90, $100 environment, drill 4, 5, 6 wells very cheaply, and then sell the entire thing as like, oh, look, we proved out 300 drilling locations using 6 wells, and sell it for a massive premium because the net asset value of that asset is just so high. And what are companies looking for? Development acreage, right? That's what they want. They want a high undeveloped area that's proven out. So that's the Sparky. They also have the Southeast Saskatchewan Frobisher play, which they got into by the acquisitions of Astra Oil and Farsky in 2021. Again, a similar situation. The market said, you are diluting us. Like, we're going to sell you shares. And they sold out. I hung in there patiently because I've looked at these assets after sale and I said, these Frobisher wells pay out in 4 to 6 weeks in some cases. And this 2x payout can happen within 3 to 4 months. So the top wells in North America, other than certain Baytex, Peavine, Clearwater wells. And so you ask me, okay, what's happening? So what Surge did was they picked the two companies that were not really wanting to sell, but the private equity wanted to exit. And what did these companies do? Their production wasn't that great, but they had 10 to 12 years of inventory of these Frobisher 4 to 6 week payout wells. And I just recently spoke to the management of one of these companies, and he said, you know what? I really wish we would have held on to this company. We had such a great money-making scenario here in a higher oil price environment, but private equity wanted out. So now Surge is sitting on this proven out, reserved tier one of the tier one lands and inventory, and they are drilling monster wells back to back to back to back. And somebody asked me, is Surge going to meet their production numbers? I would be surprised if they don't beat their production numbers by at least 10% exiting this year. And what does that give you? Extra cash flow, extra free cash flow, and just more money going forward. They also have hedges rolling off at the end of December that again increase cash flow by, I believe, $60 million a year. So you take all these factors together, and this thing, along with the net asset value being 3 times the share price, as you mentioned, I take all these factors and I see no reason to remove it or to trim or to take it off my top holding other than margin calls. And I'm still sitting here just frustrated that's the way it worked out. But when I run a 30% margin portfolio, I have to set myself up with plan A, plan B, plan C. And that's just the way the ball rolled this time around.
That's amazing. That's the difference between someone who has boots on the ground experience, understanding that you mentioned essentially a drilling operation with roughly 8 times the efficiency of the standard, and not having to pay for that steel creates such an amazing efficiency and cost reduction that
Right.
gives it an operational leverage, I suppose, for every dollar that is saved on that expense sheet can be freed up to the bottom line. And they've got a massive amount of acreage, the optionality to prove their concept. And then depending if they get the offer that they want, they can let someone else have the operational headache of developing it and make out like bandits. Last one for today, Saturn Oil. Now, this one, interesting to me, cash flow wise, has a lot of promise. Balance sheet looked terrible last I looked at it, but I found it confusing to read. Would love to get your general thoughts just on Saturn Oil.
Yeah, so this is a company that came out of this serial acquisition process. Very, very new entrant to the Canadian oil and gas field. And there's good things and there's bad things. So I'm going to begin with the bad things, and then we can go into the good things. So they have a lot of their production hedged until 2026 at well below market pricing. Now, that number does drop off. So the barrels hedged drop off by roughly 20 to 30% every year, but you're still hedged at as low as $60 per barrel into the future, when we just described a scenario where oil prices can be materially higher than those rates. So that's one issue. The second issue is the balance sheet and structure of the company. They have a lot of warrants outstanding, which can be converted into shares, which naturally creates this headwind, because as soon as you go above that, people start exercising warrants, dilution. Thirdly, management has lost trust because they've kept acquiring and kept diluting the shareholders. Shareholders now say, you know what, why should I buy this now? I can buy this in a year when they're done diluting, done doing the deals, and then I can get in. And then kind of a fourth problem, a few of their wells, recently drilled wells, have not come on good. They have been complete failures in the production that they're doing, as low as 10 to 15 barrels per day on wells that should be doing 100 plus barrels per day. So I'm watching this and I'm saying, it's a new management team. They've never run a company before. Is their engineering team up to snuff here? Can they actually execute on doing these things properly? So those are sort of the concerns here. However, this thing trades at over 100% free cash flow to market cap, even with the hedges in place. As those hedges drop off going into next year, even if 1,000 barrels drop off, that's 1,000 barrels that goes from $60 to $70 per barrel to $80, $90, $100 per barrel. It creates this massive torque on the equity part of the company, and then they have the same tailwind where every dollar of debt they retire at 10, 12, 15% interest now is coming back into the cash flow part of the business. And there's an exceptional torque here from just paying back debt. The acquisitions they also made were at really good pricing, so they didn't really overpay for anything. And they also are benefiting from going in, sort of like Journey, and taking up assets from Spur and from Crescent Point that were largely ignored assets. And they go in, they do some reactivations, they can increase production significantly without doing any drilling. So they can go reactivate wells, work over wells, fix up pumps, fix up tubings. There's a lot of remediation work that can be done to increase production at a very, very good capital efficiency. And now it comes down to, can management execute? We will see on the Q3 results, we will see on their year-end production numbers, how they do. One major catalyst on the horizon, they have a large number of warrants expiring in June and July of 2023 at $3.20 strike price. If those warrants expire worthless, that's your big dilution gone,
off the table.
Worthless. So as a warrant shareholder or as a warrant holder, you may be complaining, but as an equity holder, that is your catalyst point where you say, oh, there's this big dilution that just in one day got completely wiped out. So I would leave that as sort of my point where I would look at possibly entering a name like this would be, if I think those warrants are going to expire worthless, at the free cash flow to EV or free cash flow to market cap that this thing trades at. I believe that free cash flow to market cap number I gave you was on the hedged barrels, but when you go unhedged, I believe this thing is 100% free cash flow to EV value. So it's the hedges are having that much of an impact on this company. So yeah, this is one that definitely is on my radar. Even though I'm not a fan of management, I'm not a fan of the acreage, it just trades so damn cheap that at some point, as a value investor, you know, it just becomes attractive to the portfolio, at least to take a little position in there. So yeah, so that's sort of my thing on Saturn. I did a complete due diligence process on Saturn, where I spoke to operators in the field, I spoke to the service rig guys on the field, and really tried to figure out what is the problem here. Why does this company not trade at what it should? And the understanding I got was the negative points I mentioned here. But that may not be enough to dissuade somebody from owning these things, because at the end of the day, it's the money in the bank that counts. So yeah, a bit of a different company, one that I would say you should really spend more time doing due diligence on if you're somebody interested in it. But a very attractive company as a value investor, as an ROI chaser, definitely gets interesting.
Guilty. Yeah, it's just so hard to. That's what caught my attention for the company. It was, and so even a small allocation that I can just kind of keep an eye on over time. It just working on the theory that things that can't get any worse don't, and things that can't get any better don't. It's one that's certainly of interest to me. And guys, touching on due diligence, you've got to sign up to get on Shubham's list, where he does amazing Zoom calls, and all the links will be in the description to his Twitter, YouTube channel, and any way that you can follow him, because you just need to do it simply if you're interested in this space. There's no way around it. I would love to catch up with you in a couple of months' time and talk about things like offshore. That's one thing that we missed. But is there anything that I missed that I should have asked you that I didn't? Or is there anything else that you would like to say before we wrap it up?
Yeah, you bet. So what I do is these Sunday sessions on value companies, as I discussed. However, every quarter I do a macro outlook on oil and gas. So I go through supply, I go through demand, I go through inventories, I go through EVs, renewables, every single country, every single acreage. I go into shale companies specifically and say, this is why the growth is not going to come. And it just so happens that the next one is October 30th. So not this Sunday, but the next Sunday. I will forewarn your viewers, it will be a 6 to 7 hour session. We will go through this industry. This is for people who are not just wanting to buy something and leave it. This is if you care about understanding the macro that we discussed today, but then on a granular level that goes right down to the deepest part of the due diligence process. So any new source of supply, any new source of demand, any different issues that have been brought up to me, anytime I do this session, I get about 5 to 10 emails of people saying, no, you're wrong because you did not take this into account. Okay, I take those 5 to 10 things, I spend time researching those, and I add them to the macro presentation. So the first macro was about an hour, then it became 2, then 3, then 4, then 5. Now we're into this 6 to 7 hour macro presentation. So that will be Sunday, October 30th, starting at 12 p.m. Mountain Time. I believe that's 2 p.m. Eastern Time. I apologize to the Australian viewers. The time doesn't really do you well, but they are all recorded, so they will be posted on the White Tundra YouTube as well. But I think my passion here really is, as you may have noticed, going into the nitty-gritty details that people may not care to or may not know how to. And I'd like to do the same on the macro side. So if you're somebody who enjoys nerding out about oil, talking for that long, knowing exactly what's going on in the Brazilian offshore sector, or exactly how many EVs were sold in Chile last year, you will get that data in this presentation. And everything I say is with data and charts and graphs. There will be no opinion pieces. It will all be backed up by the latest trends and charts. So I look forward, for anyone that wants to know more, you thought that 2.5 hours or so is not enough to know oil. I welcome you to that session. And yeah, thanks, Ben, for having me. Really appreciate this. Love talking oil with fellow value investors.
It's absolutely our pleasure, sir. Thank you for making your time available, guys. It's simply a must attend. If there's anything better than talking about oil for 2.5 hours, it's talking about oil for like 5 or 6 hours with the kind of detail that Shubham goes into. Like normally, guys, there's no way you get access to that information free of charge or so easily available on the internet. So make sure you check out the links that I will be leaving in the description so that you can tag along and support Shubham and thank him for all the wonderful work that he has done. You can always use these charts as icebreakers when you go on a date, guys. Okay, just bring out some of the EV material and just wow her with your knowledge of the offshore rigs. I mean, it's just it's a great icebreaker. But on a serious note, thank you so much for your wisdom and coming on the channel. I have enjoyed this like no one can believe. And I'd love to catch up with you a few months later down the track to see what may or may not have changed and cover a few different topics, but I don't want to overstay my welcome. Thank you very much, Shubham. We're going to wrap it up now, guys. Take care, and I look forward to seeing you in another episode of the ROI podcast.